economic breakdown of what is exactly happening right now. And I've created a little PowerPoint presentation to kind of walk us through this. You can kind of see visually. A lot of times that helps a lot. So I'm going to open that up. I'm going to share my screen real fast. So bear with me one moment. All right, so let's do here, slideshow. All right, so 2021, we're all wondering, okay, what's going to happen? What is really going on here? It's been interesting so far, but I'm going to get into more of the economics behind everything to kind of show you guys where we think rates are going to go and what's happening currently. So currently, if we were to look at what rates are doing, I'm going to open up this breakdown. This is a graph of the Fannie Mae 2.5 mortgage coupon. And this is the date. If you were on the last call with me, I told you that the rates could go two ways. We could have rates improving or rates getting worse based on what the Georgia elections, the way that they went in regards to the balance in our House and Senate, whether it's going to be a House and the Senate divided with one party on each side, or the House and the Senate controlled by one party. And anytime we have one party controlling both the House, Senate, and the presidency, we see a lot more of the spending happening because any ideas will just go right through. So spending in the government will translate to more debt, which at the beginning would have to be all transferred to the bond market to raise that debt. So at the beginning of that, there's going to be an onslaught of mortgage or of bond debt that's created, that's what's caused this huge, I don't know if you see this huge drop in the bond market. That translates to higher interest rates. So just in the last 6 days, we've seen over 1.1% drop in yield on the mortgage-backed securities, which is almost an exact breakdown of points. So a rate on last Monday that cost no points, that same rate now costs 1.1 points. So that's what we saw just because of the political landscape. Now, that's what's happening now. I'm going to kind of go over, this is a short-term kind of reaction. I'm going to go over with you now what the projection is for the rest of the year. So if I can learn how to control this. There we go. So Yellen, she's back. So one of the funny things of people that follow the Fed chairs and the Fed department is we all know that Yellen loves, there's nothing she doesn't like spending money on. So we expect her name is going to be on all the money now, but we expect her to really move forward very aggressively with with spending and the different economic stimulus packages and the different policies that are going to be putting forward for this next year and year and two. So just expect that as part of the equation. The Fed, here's the Fed funds rate of mortgage rates in the last, like 36 years on this map. So you're going to see that the obviously they're dropping. The Fed runs and the mortgage rates drop along with it for the most part. Sometimes there's bounces up, sometimes there's not. But it is kind of follow the trajectory of what the Fed funds rate. The mortgage is the blue. The Fed funds rate is that red line. So they do somewhat follow, but it's not always. As you can see in 2013, we went to almost zero, but rates popped up almost 2% in rate. So the Fed funds rate does not really necessarily mean rates will always be low, but it is a good, there is a good correlation with dropping when the Fed funds rate drops. And then, I went back one. So this is a breakdown of government spending. Now this is where I really want to focus on. Government spending and debt usually yields to lower rates. So as you can see, all of these countries, Japan, Italy, the UK, when their debt goes up, the rates go down. And that just happens. So right now what we're seeing is a knee-jerk reaction to the flooding of potential flooding the bond market with new debt. But that new debt will eventually create a shrinking or a lowering of the rates. So we're probably going to see a little bit of a increase in rates to start, and then we'll see a little bit more of a taper off as we get moving forward. Let's see. So the things that are happening right now that are causing a little bit of bump are inflationary pressure. We don't have a good supply chain, so the cost of goods is going up. Inflation is an enemy of interest rates. So anytime you see inflation being a little higher, you're going to see rates being a little higher as well. There hasn't been much inflation lately, but the supply chain has started a little bit, so we're going to really watch that carefully. The labor force, obviously, that's bringing down the supply chain, and additional spending, that's going to have a little bit more of inflationary pressure. Here we go. Rates likely to bump higher before resuming downtrend. That's short term. So most of the customers I'm talking to right now have been conditioned to rates in the 2s. We could see rates in the 3s and then come back a little bit later. So they're going to be a little disappointed, but the good news is I would think maybe second quarter we'll see another rate drop for the lower. Here's one of the things on the side of the real estate that is really exciting. So the biggest population of homeowners was the baby boomers. So there were 76 million baby boomers. Well, millennials are 33 years old today is the average, and there's 66 million millennials. So those first-time home buyers are going to be coming in strong, and that's going to have a big impact on our real estate business in the next coming year or two, or more for that matter. So really focus on that first-time home buyer, and don't fall away from that big group of people, because it will be a big influencer in the amount of volume that we do moving forward. Here's the new construction. So this is kind of a breakdown of over the years how new construction is happening. Now we've seen a little bit of dip in new construction. It isn't massive, but it is a dip, as you can see. Except for, well, I'm sorry, I didn't see that part. I was blocking that. So do you see the big COVID shutdown drop? And then it peaked back up, obviously. But because of that, there's a gap in the amount of homes that are actually ready in the near future for new builds. So anytime you see inventory as lower, it's just a supply and demand factor. And here's the vacancies of homes. So national vacancy rate, this is homes that are currently empty, that are vacant. So somebody has a house for sale that doesn't have a human that's living in it right now. That number is very, very, very low. So back in 2009, when we had a lot of inventory, there was a lot of empty homes. And people were forced to sell those. They couldn't carry the double debt. So that's where we saw the big bubble, because there was too many homes out there for sale. Right now, there's hardly any people out there. I mean, there are very few homes that are actually vacant, where people are carrying 2 mortgages where they have to sell. So that's a really good sign as far as the health of the market. And that leads to the fact that there's just a lot of less inventory. And we all know a lot of people trying to buy a home first before leaving, and that's one of the factors in there as well. Now, here's the inventory. We all know it's hard to find homes for our buyers. If anyone tells you that there's a housing bubble, this will debunk that just right away. So if you look at the inventory in 2006 and 7, the inventory is quite high. We are at an all-time low right now, and it's just a supply and demand. The less inventory you have, the more demand there are for homes. Prices will rise because there's just more competition. So this is an interesting graph to show you truly where we're at. So is it a good time to buy? Yes, because as long as interest rates remain favorable, it'll be a great time to buy. There's high demand, and the appreciation is going to be pretty strong. So 6% is the estimate for 2021. So if somebody says they're going to wait, they're going to miss out on 6% appreciation in this year. And that is lower than it was in 2020. We were about 10% in 2020, which is fantastic, but it's an anomaly that can't ever sustain that. So we're expecting about 6%. So that's a breakdown, guys, of what's really happening with the markets. I know it was kind of a rushed breakdown, but I want to open it up for questions right now. But in a nutshell, we're going to see rates peak up a little bit just because of the initial change of spending habits within the Fed and with potential some small inflation. But because of that debt, it will squeeze the rates back down, and that's the year-long outlook. So expect rates a little higher in the near future, with them recovering and coming a little bit lower down in the next quarter. So I'm going to open up the chat, open up any questions. Any questions at all regarding what's going on?
Yeah, feel free to unmute yourself and just ask questions, or put them in the chat and we can read them from there.
So as you could have seen from that graph, guys, there was a big swing in the last week and a half. Usually when we see a big swing like that, we see some sort of a recovery and a rebound. So we'll see that soon, and I'll keep you guys updated. Again, every Monday we're going to be doing these as well. Any questions? Don't be shy. I don't bite.
Wow.
I'm not that good that everyone is fully knowledgeable now on every topic in mortgage.
Okay.
Hi. Can you hear me?
Yes.
Yes.
Okay, perfect. Oh, so you mentioned that in France, Japan, UK, and Italy, if the debt goes up, interest rates go down. But in the US, you mentioned the bond debt goes up, then higher interest rates. So it doesn't have, it happens the opposite here in the US?
At the very beginning stages of that cycle, it does have that impact, because the markets don't know how to adjust for the massive amounts of spending that are going to be happening. So they have a knee-jerk reaction at first, saying, okay, well, that's a lot more bonds. I don't know how the buying pool is going to be. In different countries, they print money. We don't really truly print money in the United States. We issue bonds. We issue bonds that are sold. So it's a little different, but it does eventually turn into debt. And that's where that analogy comes into play really well. The knee-jerk reaction is just the bond markets trying to adjust and like be a little bit more playing the safe game, so to speak. And then once we see the buyers, like tomorrow we have a big 10-year note auction that's going to be happening. And then on Wednesday is the 30-year bond auction. Those auctions are going to be really interesting to see the appetite for these bonds. If there's a good appetite, because we now have higher yields, because if you look, I'm going to show you something real fast. I'm going to show you the 10-year. People buy these bonds because it's a guaranteed yield. So if we see a stock market retraction, people may want to buy more bonds, or if they're predicting a stock market maybe turning the other way for a little bit. But we went from, let's look at longer term on this. We went from back in August, where the 10-year treasury was only a 50 basis point yield. We went now to above 1.1%, which is a pretty big chunk. So they're getting a little bit more for the bang for their buck as far as interest on this. So we may see a really good auction results, which then would push this back down, which would then push rates back down as well. So to answer your question, the bond auctions are what really drives the bond yields, and the overall debt in the next quarter will have the impact, just like it did Japan, Italy, and the rest. But the short term is more economics based on bond sales, and that's where we're going to see this uptick, and then they'll drop back down in the future just because of the amount of bonds that'll be out there and the amount of looming debt that we do have. I don't know if that was too complicated or not, but hopefully that answered your question.
Yes, thank you.
Can you show us the first graphic or the second graphic? I missed that, about what interest rates are doing in the last 6 days.
Yes. So let me pull that back in. Now, this is the Fannie Mae 2% bond. We have the 2.5 bond. I'm just going to show you this one because this is the one that's really driving the rates the most. So I'm going to show you more longer term. I'm going to go till September. So this last run since November, we've been in the mid to higher twos depending on the day. Now, we are all the way down, and these lines right here, they're called Fibonacci levels.
Sean, I'm
And if
not
you
seeing
see,
your.
I can't
I'm
see
sorry.
anything.
I forgot
Yeah.
to push the share screen button.
Thanks.
Hold on.
I was like, maybe it's just me, but
No, that was just I missed a step. All right, so here's, if you look back in November, these red, the
Still
red
can't
is when
see
they
it.
move downward.
I still
Can
can't
you guys see it now?
No.
Nope.
Really?
Yeah.
Did I miss
Nope.
another step? Oh, I did. There you go.
Got it.
Okay, okay. So if you look, these lines on here are called Fibonacci levels, the ones that are straight across, and those act as floors of resistance. And you can see every time the markets went down to this level right here, they bounced upward. Right here, they bounced upward. Right here, they bounced upward. So we are approaching that Fibonacci level. Most likely will happen is, based on the past trends, we will bounce upward. If we go below this, there's a lot more room to drop to the next floor. So this last 6 days, we've seen a pretty fast deterioration of what the bond markets are doing, which is driving rates up at the same ratio. Now, as you can see, the floor is pretty strong, but if you look back even further, it has been, you have to go way back to July of 2020 to see where rates were below that line of where they're at today. So you could see it. Now, if you go back even further to like where March happened, look how weird the bond market got on the far left. So just to let you know, that day on March 20th, I almost packed up my bags and started selling surfboards in Hawaii. So
Good, how are you?
that was a crazy day. Rates were about 6% that day. And I was wondering what is going to happen with the markets. And everyone was wondering what was going to happen with the markets. But then the Fed stepped in and started buying mortgage-backed securities and kind of artificially brought them back to normal. But that was the last is right here.
What kind of market are you looking at? I own the company. I'm not an agent, but I can.
I'm sorry, Mike. We can't hear you. Mike, we
I think
lost.
I think he's on the other line. I think that was his conversation. Maybe.
Oh, I was like, okay, does he have a question?
How many bath? Them two.
What's that, Mike? Yeah, I think he's on the other line.
Oh,
Christy, you can actually mute him if you can.
Okay.
I think you're right.
Yeah.
Let me find him.
So any other questions? Don't be shy. You can always jump in. I think people are going to be a little disappointed in where rates are right now. But we can always finance in the future. Chrissy, you can hover over his image and then click on the other.
I muted him.
Perfect. Any other questions? Any other questions at all? I mean, we have a lot of different programs out there that are new. We do have a stated income program, believe it or not. The rates are higher, but there's a lot of new products that's going to be coming out just because the capital markets are a little bit stronger now. But expect to see a very robust 2021 when it comes to volume on both the purchase side and the mortgage side. So that's basically it. If there's no further questions, you can always call me, shoot me a text, shoot me an email. I'm always available. Any last minute questions?
Thanks for all the information. It's really good.
Yeah,
Very,
you're welcome.
Thank you.
Thanks, guys. And remember, we're going to be doing this every Monday. So the same link, but I usually send it out anyway, so you'll get it. Thanks, everyone, for joining us today.
Perfect.
All
Thank
right,
you.
guys. Have a great one. We'll talk to you guys soon.
Bye-bye.
Thanks.
Thank you.